Imagine a factory, right? But the raw material arriving on the loading dock, it isn't steel or lumber or, plastic.
Right.
The raw material is electricity and raw data. And the product rolling off the assembly line isn't a car, it isn't a smartphone. The product being manufactured and boxed up and shipped out is, well, human-level reasoning.
Which is a crazy concept to wrap your head around.
It's totally nuts. And now imagine that this factory operates at a 75% profit margin, and it's generating so much cash that the financial models used by Wall Street analysts are just like functionally breaking.
Yeah, they're tearing their hair out trying to model this.
Exactly. So today we are looking at the company building those exact factories.
Because we're essentially looking at a fundamental rewiring of global infrastructure. I mean, to understand what is happening in the technology sector right now, you really have to look at the foundational layer.
Welcome to the deep dive. Our mission today is to map out a corporate evolution that, frankly, defies normal economic gravity. We are unpacking NVIDIA's Q1 fiscal 2027 earnings call.
Which took place on May 20, 2026, just for context.
Right, May 20, 2026.
Yep.
And for you, the listener, whether you're holding the stock, thinking about buying it, or just trying to understand the market, we have gone through the source material so you don't have to. And let me tell you, this transcript is incredibly dense.
Oh, it's a beast.
Yeah, it's packed with data-forward financial metrics, Wall Street jargon, bleeding-edge semiconductor terminology, and concepts that literally sound like science fiction. But they are currently dictating billions of dollars in capital expenditure. We've got CEO Jensen Huang, CFO Colette Kress, and like a whole roster of equity analysts who spend their lives modeling tech valuations.
And finding that traditional valuation metrics are really struggling to capture the reality of this hardware cycle. I mean, our goal here is to translate this into plain language. We're going to look past the headline numbers to decode the technological shifts NVIDIA is predicting. Specifically, the rise of what they are calling agentic AI, and this entirely new frontier of physical AI.
So whether you are prepping for an investment committee meeting, trying to evaluate where the enterprise software landscape is heading, or you're just intensely curious about what computing looks like 5 years from now, consider this your ultimate shortcut.
Yeah, we're cutting through the noise.
Exactly. By the end of this conversation, you will understand exactly where the internet of the 2030s is being forged. It's like they started out selling picks and shovels during a gold rush, but somehow they've maneuvered to own the gold mines, the railroads, and the banks too.
That's a great analogy. But to do that effectively, we really must start with the math. Because before we analyze autonomous AI agents surfing the web or robotaxis, navigating physical cities, we have to ground ourselves in the sheer financial velocity of this present quarter.
The numbers.
Yeah, the numbers in Q1 of fiscal 2027 are historically unprecedented for an industrial company.
So let's lay out those headline numbers, because they are staggering. Total revenue for the quarter was $82 billion.
In one quarter.
A single 3-month period. That is up 85% year over year, and it's a 20% sequential jump just from the prior quarter.
Which, if you think about it, adding $13.5 billion in new revenue in 90 days is the equivalent of swallowing a legacy Fortune 500 company whole every single quarter and just purely adding it to the top line.
Just bolting it on. It's wild. And out of that $82 billion, the data center segment, so the actual infrastructure powering artificial intelligence, that made up $75 billion. Yeah. But the metric that really stands out the most in this transcript, I mean, for any retail investor looking at the fundamentals, is the free cash flow.
The cash generation is what makes this real.
Exactly.
Yeah.
They generated a record $49 billion in free cash flow in one quarter. And alongside that, they're reporting non-GAAP gross margins sitting at 75%. Plus, management guidance for Q2 is projecting $91 billion in revenue.
It's just relentless growth.
And, a massive capital return program. They announced an $80 billion share repurchase authorization.
So we really need to unpack what a 75% gross margin actually signifies in this specific context. Because NVIDIA is a hardware company.
Right.
They design physical objects requiring silicon, copper, really advanced packaging, and incredibly complex thermal management systems. I mean, they manage a global supply chain spanning massive fabrication plants in Taiwan, global shipping logistics, physical assembly.
They are bending metal. They are shipping server racks that weigh thousands of pounds. Like, you could drop their product on your foot.
Precisely. And in the traditional hardware space, an original equipment manufacturer, like a company building laptops or standard enterprise servers, they might operate on a 20 or maybe 25% gross margin.
Which is normal.
Right. They buy the components, assemble them, add a small markup, and ship them out. A 75% gross margin is a software margin.
Yeah.
It's the financial profile of a company that writes a piece of code once and distributes it digitally over the internet at essentially zero marginal cost.
So how does a company dealing with arguably the most complex physical supply chain in the history of human engineering achieve software margins? Like, how is that physically possible?
It comes down to pricing power and the concept of value capture. NVIDIA is not pricing their silicon based on what it costs to manufacture plus a 20% markup. They are pricing their systems based on the immense value those systems unlock for the end user.
Because there's no real alternative.
Exactly. Because they have a functional monopoly on the most efficient AI infrastructure, they are able to capture the vast majority of the economic surplus created by the AI boom. I mean, they pay their foundry partners, like TSMC, a fixed cost to print the wafers, but NVIDIA captures the exponential premium.
And that dynamic creates an absurd amount of capital. And amidst all this intense world-changing math, there was a moment on the call that highlights just how much cash we were talking about. It's actually kind of funny.
Oh, the dividend thing?
Yeah. So CFO Colette Kress was detailing the capital return program, and she announced that the quarterly dividend was increasing from 1 cent to 20 cents per share.
Which is a massive percentage increase on its own, signaling immense confidence in their sustained cash flow.
Right, going from 1 cent to 20 cents. But then during the Q&A session later in the call, Jensen Huang chimes in to casually correct his own CFO. He says, I'm paraphrasing here, first of all, Colette meant to say we're increasing our quarterly dividend from 1 cent to 25 cents. I think that extra 5 cents would mean a lot to the large shareholders.
The casual nature of that correction is just fascinating.
It's such a flex.
It really is. I mean, tossing an extra 5 cents per share onto a quarterly dividend across billions of outstanding shares, that represents hundreds of millions of dollars in cash out the door annually.
Just a rounding error to them.
Delivering that correction off the cuff on a public earnings call reflects a management team operating with a level of financial freedom that is almost unheard of in modern public markets.
But, if you are an analyst or an investor trying to model this, you have to be asking, where is the ceiling? With a company doing $82 billion in a quarter, guiding for $91 billion the next, generating $39 billion in free cash flow. I mean, historical precedent suggests a cyclical bust is inevitable.
A reversion to the mean?
Exactly. The market has to saturate, right? At some point, the hyperscale cloud providers have enough chips, the capital expenditure slows down, and this parabolic growth chart crashes back to earth. So how is NVIDIA convincing Wall Street that this isn't a bubble about to pop?
That is the existential question for the stock. And Jensen Huang addressed it by attempting to redefine the entire unit of measurement for the industry. He repeated a specific phrase multiple times on the call. He said, customers do not buy GPUs, they build AI factories.
But I mean, that just sounds like a marketing pivot, right? Mm-hmm. How does calling it a factory change the actual financial reality of market saturation?
Because it changes the metric of return on investment. Historically, a data center operator would look at a central processing unit or a standard graphics processing unit and ask, what is the capital cost of this hardware and what is its depreciation schedule?
The physical asset.
Right. Today, the primary metric is tokens per dollar.
So the industry has entirely moved away from hardware pricing to a cost per token model.
Exactly. The hardware's value is purely a function of the intelligence yield it produces over its lifespan. A token is the fundamental unit of AI computation. It's a fraction of a word, a pixel in an image, a fragment of code.
Okay, so a unit of output.
Yes. When a cloud provider buys an NVIDIA system today, they are evaluating how many trillions of tokens that system can generate over 4 years and at what energy cost.
So long as the end user market is willing to pay for those tokens, the cloud providers are printing money.
And the transcript provides the data point proving the demand is holding. The price of renting an H100 chip, which is NVIDIA's flagship architecture from the previous year, in the public cloud has actually risen 20% year to date. Even older generation A100 chips saw rental prices increase by 15%.
Wait, hold on. If the physical hardware is aging, basic economic theory dictates the rental price should decrease as the hardware depreciates and newer chips enter the market. Why is the cost to rent an old chip going up?
Because the software models running on top of those chips are becoming radically more efficient. An AI model today can extract far more useful intelligence, so more valuable tokens, out of an older A100 chip than it could a year ago.
Oh, wow.
The yield of the factory is improving due to software optimization, making the underlying physical asset more valuable to rent.
That's wild.
The cloud providers, who are NVIDIA's direct customers, are seeing massive returns on their infrastructure investments. As long as those cloud providers remain highly profitable renting out compute, they are incentivized to buy every single rack NVIDIA can produce.
So the demand constraint isn't capital, it's the end-user appetite for intelligence. If software developers and enterprises stop needing AI tokens, the whole machine grinds to a halt, which I guess forces us to look at the software layer. Why is the software demanding so much more compute right now? What is driving this insatiable appetite for tokens?
And this brings us into the second major theme of the transcript, the shift in how AI is fundamentally operating.
Right. Jensen Huang stated on the call, unequivocally, that agentic AI has arrived.
This is the catalyst for the sustained infrastructure demand.
Yeah, the transcript outlines an evolution over the past few years. We started with one-shot inference. You type a prompt into a chatbot and it predicts the next sequence of words to give you an answer. It's a single, isolated transaction.
And the compute required for one-shot inference is relatively linear. The user asks a question, the model processes the parameters, generates the output, and goes dormant.
Then we saw the evolution into reasoning models. You give the AI a complex logic problem, and it visibly pauses. It generates an internal chain of thought, evaluating different approaches, checking its own logic, and then presenting the final answer.
Right, and that reasoning phase requires significantly more compute because the model is essentially prompting itself multiple times in the background before giving the user the final output.
But now we are crossing into agentic AI. What separates an agent from a reasoning model?
It's autonomy and the ability to utilize external tools. An AI agent is not confined to the data it was trained on, nor does it wait passively for a human prompt. An agent is given a high-level objective, and it determines the sequence of actions required to achieve that objective by interacting with software environments.
So if we think about the old one-shot inference as an interactive encyclopedia, agentic AI is more like hiring an autonomous digital intern.
That's a perfect way to look at it.
You don't ask it for a fact, you give it a mission. You say, analyze the supply chain risks in our Southeast Asian operations based on this morning's geopolitical news, cross-reference it with our internal inventory database, write a risk assessment brief, and distribute it to the procurement team.
And to execute that objective, the primary agent must break the mission down into subtasks. It realizes it needs current news, so it spins up a subagent equipped with a web browser tool. It realizes it needs internal data, so it spins up another subagent equipped with SQL database access.
Right.
It needs to synthesize the data, so it creates an analytical subagent. Each of these subagents operates independently, retrieves information, and feeds it back to the primary agent for verification.
And every single action, evaluating the goal, deciding to use a web browser, analyzing the search results, realizing the search results are incomplete, running a second search, querying the internal database, formatting the final email. Every single step in that loop requires a dedicated burst of instance compute.
Exactly. The multiplier effect on compute demand is just staggering. We are transitioning from a paradigm where one human prompt generates one inference workload to a paradigm where one human prompt triggers hundreds or maybe thousands of autonomous machine-to-machine inference workloads in the background.
When Jensen Huang predicts a future with billions of agents interacting with the internet and each other, he is describing an exponential explosion in background compute. It's an economy of automated digital labor.
And that digital labor economy fundamentally alters the architectural requirements of the data center, which actually brings us to perhaps the most aggressive strategic pivot discussed on this earnings call.
Yeah, the introduction of the Vera CPU. I mean, this segment of the transcript completely rewrites NVIDIA's traditional narrative.
Yeah.
If you're an investor, this is a massive shift to pay attention to.
For sure, because for over a decade, the core thesis of NVIDIA has been the supremacy of the graphics processing unit, the GPU, over the central processing unit, the CPU. The GPU, with its thousands of smaller cores, was perfect for the massive parallel processing required by artificial intelligence. The traditional CPU, designed by companies like Intel and AMD based on the x86 architecture, was largely relegated to a managerial role.
The narrative was always that CPUs were legacy technology. They were just traffic cops directing data, while the GPU did the actual heavy lifting of deep learning. But now, NVIDIA is aggressively pushing its own custom-built central processing unit named Vera. They claim it is purpose-built for agentic AI, delivering up to 1.5 times faster performance per core and 4 times the density per rack compared to standard x86 alternatives.
And more importantly for the financials, they noted visibility into $20 billion in total CPU revenue for this fiscal year, expanding into a brand new $200 billion total addressable market.
Wait, let's unpack this, because if the GPU is the undisputed engine of the AI revolution, why is NVIDIA suddenly devoting massive R&D and supply chain capacity to building a CPU? It seems completely counterintuitive to their entire historical thesis.
It is, but it's a direct response to the mechanical bottlenecks created by agentic AI. We have to look at the physical architecture of a server. To use an anatomical framework, the GPU is the brain. It handles the deep, complex pattern recognition and the heavy mathematical inference, but the CPU acts as the hands and the nervous system.
Okay, so the CPU manages the input and output, the memory retrieval from storage, the network interfaces.
Precisely. When an AI agent is simply predicting text, the GPU can handle the bulk of the workload internally. But when an agent needs to use a tool, like when it decides to open a web browser, execute a Python script, or query an external database, it cannot do that natively.
Oh, I see.
The GPU must hand that request back to the CPU to execute the tool function, retrieve the data, and feed it back into the GPU's memory.
So if an agent is executing hundreds of tool queries a second, the communication back and forth between the GPU and the CPU becomes the limiting factor.
Exactly. The legacy x86 CPUs from Intel and AMD simply cannot fetch data, operate software tools, and feed the GPU fast enough. The data transfer protocols, which typically use standard PCIe lanes, create a massive latency bottleneck. You end up with a scenario where a $30,000 NVIDIA GPU is sitting idle, waiting for a legacy CPU to hand it the next piece of data.
And that is unacceptable when your customer's entire business model relies on maximizing the tokens per dollar yield of that GPU. An idle GPU is just burning capital.
So NVIDIA's solution is absolute vertical integration. By designing the Vera CPU based on the ARM architecture, they can customize the instruction set specifically for AI workloads. Furthermore, because they control both the CPU and the GPU, they can connect them using their proprietary NVLink technology,
which vastly increases the bandwidth and bypasses those traditional industry standard interconnects.
Right. They aren't just selling a faster processor, they are selling a friction-free ecosystem. The Vera CPU ensures that the GPU is fed with data at the absolute physical limit of the hardware.
This fundamentally reclassifies NVIDIA as a business. They are no longer a merchant silicon vendor selling an accelerator card to be plugged into someone else's server. They are selling the entire computing stack.
The whole thing.
The GPU brain, the Vera CPU hands, the networking nervous system, and the proprietary software layer orchestrating it all. Which, requires Wall Street to completely rethink how they value the company's revenue streams and customer relationships. When you transition from selling components to selling fully integrated infrastructure, the profile of who is actually buying your technology changes dramatically.
And this takes us into the restructuring of their financial reporting framework, which is a huge part of this call.
Yeah, let's talk about the buyers. Because historically, NVIDIA's primary revenue driver was housed under this monolithic data center segment. And the long-standing bear case, like the primary risk factor cited by skeptics, was customer concentration. Analysts were constantly worried that NVIDIA was overly reliant on a handful of hyperscalers.
The titans of the cloud, Microsoft, Amazon Web Services, Google, Meta.
Right. The fear was that these 4 or 5 companies were engaged in a massive short-term capital expenditure arms race. And once they finished building their massive AI data centers, the orders would halt and NVIDIA's revenue would just fall off a cliff.
But on this call, NVIDIA split that data center reporting into 2 distinct submarkets, which directly addresses that bear case.
Yeah.
The first submarket remains hyperscale, which brought in $38 billion. But the second submarket, which they termed ACIE, standing for AI Clouds, Industrial, and Enterprise, brought in $37 billion.
And the fact that ACIE is functionally identical in size to the hyperscale segment and growing at 31% quarter over quarter is a profound structural shift. It proves that the demand for AI infrastructure has broadened far beyond just the Silicon Valley tech giants. But who specifically makes up this ACI segment? Like, who is buying $37 billion of infrastructure outside of Google and Amazon?
It encompasses a really wide spectrum. It includes AI-native cloud providers like CoreWeave, who are building specialized data centers purely for AI workloads.
Yeah, Right, they often outcompete traditional clouds on latency and price for specific inference tasks.
Exactly. It also includes traditional Fortune 500 enterprises. So pharmaceutical companies running molecular dynamics simulations, financial institutions operating proprietary algorithmic trading agents, automotive manufacturers processing petabytes of crash simulation data.
And these enterprise customers, they don't want to buy naked chips and architect their own networking protocols. They want to buy the turnkey AI factory we discussed earlier, where the Vera CPU, the GPUs, and the software are all pre-integrated.
Yes. But the most fascinating subcategory within ACIE, and this generated intense focus on the call, is sovereign AI.
Right, sovereign AI.
NVIDIA reported that sovereign revenue increased 80% year over year.
So we are seeing individual nation states recognizing that sovereign computing capacity is basically a matter of national security, economic independence, and cultural preservation.
The geopolitical reality here is that artificial intelligence is becoming the foundational layer of modern economies. Now, and just looking at the facts here without taking any sides, a nation cannot rely on a public cloud infrastructure hosted in another jurisdiction, controlled by a foreign corporation, subject to foreign laws, to run its national defense logistics, its electrical grid management, or its healthcare data processing.
The concept of data gravity and data sovereignty forces infrastructure localization. Like, if a European nation has strict privacy regulations regarding citizen health data, that data cannot legally leave the country to be processed by an AI model in a hyperscale data center in Virginia. The compute must be moved to where the data resides legally.
Furthermore, there's the issue of cultural alignment. Foundational AI models are trained on specific data sets that encode the cultural values, biases, and legal frameworks of their creators. Nations in the Middle East, Asia, and Europe are investing billions to build their own sovereign supercomputers so they can train proprietary foundational models on their own localized data.
Right, in their native languages, aligned with their own societal norms. Jensen Huang actually noted that NVIDIA's infrastructure is now deployed across nearly 40 countries, representing $50 trillion in global GDP. They are essentially arming nations with the infrastructure of the 21st century.
And this diversification, from the cloud to the enterprise to sovereign nations, provides a massive layer of stability to NVIDIA's revenue streams, which is what investors want to hear.
Absolutely.
Even if one hyperscaler slightly reduces capital expenditure in a given quarter, the localized demand from a dozen sovereign nations smooths out that volatility.
So we've established that the infrastructure is scaling out globally, but the applications in this intelligence are also expanding beyond the digital realm. The focus is no longer just on software agents browsing the internet. It is bleeding out into the physical world.
Right. And this brings us to the edge computing segment, which generated $6.4 billion in the quarter and grew 29% year over year. However, the trailing 12-month revenue for the broader category of physical AI reached $9 billion.
So what exactly constitutes physical AI in this context? How does it differ from the agentic AI we analyzed earlier?
Well, agentic AI operates in a purely digital environment. It reads text, writes code, queries databases. Physical AI must interact with the laws of gravity, friction, momentum, and, human unpredictability.
Right, the real world.
It encompasses robotics, automated manufacturing logistics, surgical robotics, and autonomous vehicles.
And the transcript highlighted a major partnership with Uber to deploy fleets of robotaxis across nearly 30 cities in 4 continents by 2028. Moving a 2-ton vehicle through a chaotic urban environment requires a radically different type of compute architecture.
It requires an extraordinary amount of localized inference, so compute happening directly on the vehicle in real time, because you cannot rely on a cloud connection with 50 milliseconds of latency when a pedestrian steps into the street.
Yeah, that's life or death.
But more importantly, the training phase for physical AI requires immense data center infrastructure.
Because you cannot train an autonomous vehicle entirely by having it drive aimlessly on physical roads. The iteration cycle is just too slow. And the edge case scenarios, like, a child running out from between parked cars in a snowstorm, those are too rare to capture reliably in the real world.
Therefore, you must build hyper-realistic digital twins. NVIDIA's Omniverse platform allows companies to simulate entire physical environments with accurate physics engines.
So they can train the AI driver across billions of simulated miles, exposing it to every conceivable weather condition and traffic anomaly before the software is ever loaded onto a physical car.
Exactly. Training models to understand the physical world requires orders of magnitude more compute than training language models.
Yeah.
Because you are processing massive streams of high-resolution video, LiDAR, and radar data continuously.
And this relentless demand for heavier compute dictates NVIDIA's product cadence, which is moving at a speed that is actively disrupting standard corporate procurement cycles. If you're holding the stock, this cadence is either thrilling or terrifying, depending on how you look at it.
Let's examine that cadence, because it's wild. On the earnings call, they stated that the Blackwell architecture, which is just beginning to ship right now, is the fastest ramping product in the history of the company. Demand exceeds supply wildly.
Right.
Yet in the very same presentation, they announced they are launching the next generation architecture, Vera Rubin, starting in Q3 of this year. And Vera Rubin is projected to deliver up to 35 times higher inference throughput.
Wait, not a 35% improvement, a 35x multiple in throughput efficiency.
35x.
If I am the chief financial officer of a major cloud provider, and I have just authorized a multi-billion-dollar purchase order for Blackwell systems today, and NVIDIA tells me Vera Rubin is coming out in a matter of months with 35x the performance, I am immediately halting my orders.
It sounds like you would, yeah.
Why buy today when the product is basically obsolete tomorrow? This is the textbook definition of the Osborne effect, where pre-announcing a future product cannibalizes current sales. How is NVIDIA avoiding a total collapse in short-term demand?
In a normal commodity market, the Osborne effect would absolutely apply. But we are not in a normal market. We are in an arms race for frontier intelligence. We have to return to the fundamental premise: compute capacity is directly correlated to revenue generation for these companies.
So the math of AI model training creates a forced march of continuous capital expenditure.
Exactly. Let's use the frontier model developers as an example. The transcript noted that OpenAI launched GPT 5.5, which was co-designed for and trained on the Blackwell architecture. Concurrently, Anthropic is massively expanding its compute capacity across its cloud partners. If a competitor decides to delay their hardware upgrades to wait for Vera Rubin, they are voluntarily pausing their research and development for 6 months.
And in that 6-month window, their competitors utilizing Blackwell will train and deploy models that are vastly superior, capture market share, and generate the revenue required to fund their next hardware purchase.
The risk of short-term hardware obsolescence is completely dwarfed by the existential risk of falling behind in model capabilities. The cloud providers and AI labs are functionally trapped in an upgrade cycle. They must buy Blackwell today to remain competitive today, and they will be forced to buy Vera Rubin tomorrow to remain competitive tomorrow.
Wow.
NVIDIA has successfully accelerated the replacement cycle from a standard 3 to 4 year server depreciation schedule to a near annual upgrade mandate.
That dynamic is brilliant from a revenue perspective, but it creates a horrifying logistical challenge. Designing a new chip architecture every 12 months is one thing. Physically manufacturing and delivering hundreds of thousands of these incredibly complex systems to data centers globally is an entirely different problem, which forces us to examine the harsh realities of the physical supply chain. This was the final major theme of the call.
And the financial commitment to securing the supply chain is just staggering. NVIDIA reported increasing its total supply commitments, which encompasses inventory on hand, long-term purchase agreements with suppliers, and prepaid manufacturing capacity to $145 billion.
To put $145 billion in supply commitments into context, they are effectively forward purchasing the global capacity of the semiconductor industry. They are locking up foundry time, memory production, and advanced packaging facilities years in advance.
Because they are operating under the assumption of generating $1 trillion in Blackwell and Rubin revenue from 2025 through calendar 2027, you cannot execute that level of scale on a spot market basis.
No, absolutely not. The constraint is rarely the raw printing of the silicon wafer at a foundry like TSMC. The real bottleneck is often the advanced packaging, specifically the CoWoS or chip-on-wafer-on-substrate process.
Right, because these modern AI processors are not single monolithic pieces of silicon. They're complex assemblies of multiple logic chips and massive stacks of high bandwidth memory tightly packaged together to minimize the physical distance data has to travel.
Right, for speed.
The manufacturing yield and throughput of that specific packaging technology dictate how many systems NVIDIA can actually ship.
And CFO Colette Kress emphasized that NVIDIA is no longer just designing chips and tossing the schematics over the wall to a manufacturer. They are co-architecting the entire supply chain alongside TSMC, the memory vendors, and the server rack assemblers to engineer new manufacturing processes capable of scaling to their volume requirements.
When you become the architect of the global AI factory, you are forced to become the architect of the industrial base that builds the factory.
But within this global supply chain discussion, there is a massive geopolitical anomaly that we have to address, which is the China question. The transcript revealed a stark reality regarding export controls and global decoupling.
Now, just looking at the facts reported in the call, the United States government has implemented stringent export restrictions preventing the most advanced AI accelerators from reaching Chinese markets.
They cite national security concerns regarding military modernization.
Right. And in response, NVIDIA engineered a slightly detuned chip, the H200, designed specifically to comply with those export thresholds.
And the U.S. government approved the export licenses for the H200. Yet, on the earnings call, NVIDIA reported generating zero revenue from China in the quarter. Furthermore, they explicitly excluded the Chinese market entirely from their $91 billion Q2 revenue outlook.
From an analytical standpoint, this highlights the immense friction introduced by geopolitical decoupling. Even with approved licenses, the bureaucratic hurdles, the uncertainty of future regulatory changes, and the shift of Chinese enterprises toward domestic silicon alternatives create an environment where NVIDIA simply cannot rely on that market for short-term forecasting.
But the kicker is, China has historically been one of the largest and most critical technology markets in the world for U.S. semiconductor companies. The fact that NVIDIA can guide for $91 billion in a single quarter while writing off the Chinese market entirely is the ultimate testament to the parabolic demand everywhere else.
It's unbelievable.
The United States, Europe, sovereign nations in the Middle East, and the AI-native cloud providers are consuming every single unit of compute NVIDIA can physically produce. So if you're an investor trying to figure out if that geopolitical risk breaks the stock, the numbers suggest that right now the demand is just backfilling any gap instantly.
Yeah, that's exactly what the data shows. We have analyzed a massive amount of technical and financial data across this transcript. To sort of synthesize this for the listener, we are witnessing the real-time evolution of an infrastructure monopoly.
Yeah, we have tracked how NVIDIA transitioned from a vendor selling graphics cards to the architect of the fully integrated AI factory. We explored how the shift toward autonomous agentic AI forced an exponential increase in background compute, which led NVIDIA to build the Vera CPU to eliminate those architectural bottlenecks.
We saw how they leveraged that full-stack approach to diversify their revenue streams, proving that the demand extends far beyond a few hyperscalers. It's taking root in enterprise applications and massive sovereign AI build-outs.
And we examined the physical realities, right? The push into robotics and autonomous systems, the forced march of an annual product cadence immune to the Osborne effect, and a $145 billion supply chain commitment navigating the complexities of a bifurcated global market.
If you are evaluating the technology landscape over the next decade, this earnings call serves as the foundational blueprint. The hardware architecture being laid down into data centers today dictates the software reality of tomorrow.
100%.
The agentic workflows that will automate enterprise tasks, the autonomous systems that will navigate our physical world, and the localized AI clouds that will secure national data, they are all constrained or enabled by the infrastructure being deployed in this exact hardware cycle.
Understanding this cycle is the key to understanding where the capital is flowing and where the value will be captured in the 2030s. So for the retail investors listening, the bottom line signal from this transcript is that the underlying drivers of this growth are structural, not just cyclical hype.
That's the takeaway.
But as we conclude this deep dive, there is one final, much larger implication of this massive compute build-out that we should really consider.
It revolves around the nature of the internet itself.
Yes, Jensen Huang's vision of billions of autonomous AI agents utilizing tools, browsing the web, and communicating with each other, it suggests a fundamental shift in digital traffic. Because right now, the internet is primarily a human-to-human or human-to-machine interface. We generate the clicks, we read the articles, we initiate the transactions.
But if these agentic frameworks scale as predicted, powered by this new generation of compute, the volume of automated tasks will completely dwarf human activity.
When your digital intern is scraping thousands of web pages an hour, negotiating with another company's digital intern to schedule a meeting, and querying global databases simultaneously, what does the internet actually look like when machine-to-machine traffic outnumbers human traffic by a factor of 100 to 1?
It's a crazy thought.
When the vast majority of content is generated by AI, read by AI, and acted upon by AI, the underlying architecture of the web, how we design websites, how we monetize attention, how we verify identity, it must completely transform. Who is the internet actually for at that point?
It really becomes a transition from an internet designed for human consumption to an internet optimized for algorithmic extraction. And the companies controlling the compute that powers those algorithms will effectively dictate the rules of that new digital economy.
It's a huge shift, and we will continue to track that evolution right here. Thank you for joining us on this deep dive into the architecture of the future. Keep questioning the fundamentals, keep looking for the mechanics behind the metrics, and we will catch you on the next deep dive.